Thank you. Thank you. It's an absolute pleasure to be here. And I'm truly hoping that next year we can all actually meet face to face, as it's been for everyone a little bit difficult with all the online conferences and all the Zoom calls. So looking forward to see some faces next year around. So thank you so much for having me around. I will touch upon a subject that is extremely popular nowadays, and it has to do with centralized and decentralized financial applications. So I'll take you through what my view is on CeFi and DeFi, how they develop, and what are the key differences, and ideally, what should an investor choose when they look into investing in crypto? Should they go for a CeFi solution or should they go for a DeFi solution? So if we look at the economy today, it has been saturated with a lot of new and emerging forms of consumption, right? And these trends of consumption have resulted from the confluence of a number of factors: technological, economic, social, cultural, and these factors are currently shifting the conventional forms of commercial exchanges. And major developments in computer sciences and mathematics have led to the emergence of the blockchain technology in 2008. And this technology has led to the amplification of genuine peer-to-peer transactions. And these transactions are done with limited intermediation. And with the rapid growth in cryptocurrencies, the blockchain became an underlying technology that has attracted a lot of attention. And while the blockchain technology is really known for its application in multiple sectors, from governmental services to procurement, I will of course focus this presentation today on the trending cases, use cases of the blockchain, the CeFi, and the DeFi. So cryptocurrencies today exist solely in the digital world, right? And they're used to integrate and exchange digital information through a process facilitated by the principles of cryptography, and they enable secure and verifiable transactions on the blockchain. Cryptocurrencies are traded on global platforms, many of which you're very familiar with, and they're based on the principle of peer-to-peer exchange. And while some cryptocurrencies may be used as a means of payment right now, they're actually not considered still a legal tender because they're not issued by government or by any central bank, not at least until today. And while the crypto market cap really increases by the day, and it is rather sizable at the moment, over 2 trillion worth of dollars, it is still very negligible if you compare it to the global equity marketplace. And then it is estimated that less than 2.5% of the global population actually holds crypto. But if we want to gauge the adoption of crypto and digital currencies, how do we do it at present? So we can measure it using the very popular adoption S-curve method. And I'm really sorry that I don't have the adoption S-curve picture right now, but if you imagine the letter S, this would be our S-curve of adoption, which we will try to use to gauge the adoption of cryptocurrency with. And this method reflects the cumulative rate at which a population adopts a new technology or a product. So the S-curve would break the global adoption into 5 stages along the growth cycle. First, you have at the bottom left-hand side of the letter S, this is the innovator stage. And then you have slowly moving up the S letter, the early adopters, the early majority, late majority, and the laggards. So if we take Bitcoin as the first cryptocurrency out there, and a very young asset, actually a little bit more than 12 years young, it is much earlier along the curve than gold, for example, which has been in their laggard stage for over a millennia. And we believe Bitcoin is in its early majority phase currently, as it is measured by the number of global investors and the total amount invested in Bitcoin so far. But as we move through the early majority phase into the late majority phase, the demand and the growth of Bitcoin will continue to accelerate. And in geographic terms, if we look, let's say, at the European landscape, since we're at the Blockchain Europe Convention, it is evident that while Western European countries continue to lead the chart in terms of total value invested in crypto, and countries like the UK, Germany, Switzerland, and France are actually topping up the charts in terms of amount of crypto invested, it is really important to make a notice about the emerging countries in Eastern Europe, which actually take the first and the second rank when it comes to number of people that have been investing in cryptocurrencies based on the total population of the country. So Ukraine and Russia comes at number 1 and Ukraine comes at number 2. Our currency with high cryptocurrency usage across all the components of the cryptocurrency adoption index, which indicates actually a larger share of residents that have shifted more of their financial activities into the cryptocurrency side, and that is compared to residents in other European countries. And of course, if we speak of crypto adoption, we cannot not mention the role of institutions in the S-curve, right? In 2020, everybody was assuming that 2021 will be the year of institutions in crypto, and that actually came to life. Bitcoin and other cryptocurrencies have been drawing increasing attention from mainstream financial institutions and Wall Street players, and that, of course, comes alongside the growth and focus from governments and regulators as well, as they enter into the heated discussions about whether or not cryptocurrencies should exist in their current state and to which extent should we regulate the usage of crypto. And just a few days ago, news had it that Goldman Sachs, for example, have filed an application to the SEC for a new investment income producing product that would track an ETF exposed to Bitcoin shares. And while exchange-traded funds linked to Bitcoin are actually not existent in the US, for example, they're extremely popular in places like Canada and in Bermuda. Citigroup, for example, recently published a report where they have laid out a case for Bitcoin to play a bigger role in the global financial system. And they actually said that the cryptocurrency could become the currency of choice for international trade in the years to come. And, you know, Visa recently announced their partnership with Circle and their first USDC, so native stable coin settlement system that would allow players or program managers and card issuers to settle USDC or USDC stablecoin directly to Visa instead of using the normal fiat USD or euros, for example. And you also have companies like PayPal that have opened Bitcoin payments to their US customer base. So it's really evident with these large names coming into the play that digital assets have entered the institutional portfolios, and they're actually there to stay. This is just the beginning of that trend. And while banks and large firms have continued to dip their toes deeper into the world of digital assets, there is a small group of corporations that are very busy to add coins to their balance sheet. Notably, MicroStrategy, the company that is led by the famous proponent of crypto, Michael Saylor, they have announced recently that they've purchased additional amount of Bitcoin, and they've increased their crypto asset exposure to 91,579,000 Bitcoins. And that, if you look at today's value, I haven't looked how the Bitcoin price changed in the last 15 minutes, but it's around $5.5 billion worth of Bitcoin that they have on their portfolio. Not to mention, you have Elon Musk that made the $1.5 billion investments in Bitcoin, and Jack Dorsey, the CEO of both Square and Twitter, who has invested 170 million Bitcoin worth dollars worth of Bitcoin with Square, and they have also announced recently on Twitter that the company would be adding Bitcoin to their portfolio. So clearly, a lot of institutional players entered in 2021 into the crypto space, and this would actually have a huge effect on the adoption curve of cryptocurrencies. So if we have to easily define the crypto ecosystem, and what kind of applications does it have, I would like to kind of simplify the very technical explanations about the layers of the crypto ecosystem and bring it down to three components. The first one, I'm going to use the basis, the underlying infrastructure, which is the blockchain network that lays the foundation upon which the different layers are being added and different applications being built. The second layer would be the digital asset layer. This is the cryptocurrencies that are underlying the underlying utility of the network. And then last but not least would be the application layer. And this application layer would offer the interface to the user, and this interface would provide investors, whether they're retail or institutional, access to various products and services that address, amongst other things, all uses of traditional financial products, but in a new and obviously very innovative way that does not involve intermediaries such as banks or clearing houses. And currently, there are two ways to offer financial services on the blockchain: centralized and decentralized way. So what are the differences between those? While blockchains would operate in a decentralized manner, the first financial applications that emerged into the crypto space offered centralized financial products, right? And in CeFi, users would trust a centralized company, an entity, an institution that would store the funds and provide various services to the users. Currently, the majority of CeFi solutions are actually related to cryptocurrency trading. And as you know, when the industry first started emerging to the retail investors, it was primarily cryptocurrency exchanges that were operational, although currently there are many companies that offer other services as a layer on top of just cryptocurrency trading. So cryptocurrency trading on centralized exchanges actually happens off-chain, right? And it uses the blockchain to move the assets in and out of wallets. So when you trade the transaction, it is not reported to the blockchain. That's why it's called off-chain. So recently, we have seen, obviously, the exceptional rise of DeFi products, and they are likely to have a significant impact on how banks operate in the future. And there are a lot of specialists that say that they have the potential to shift the structure of the whole financial system at a macroeconomic level. DeFi, in short, is an umbrella term that encompasses the vision of a financial system that functions without any intermediaries and is operated just by the power of smart contracts. DeFi applications are striving to fulfill the services of traditional finance, but they're doing it in a permissionless, global, and transparent manner. And later down the presentation, we're going to talk about what exactly is a permissionless and transparent manner compared to the centralized financial applications. To visualize all of it, DeFi is all about transforming traditional banking services to decentralized architectures that are managed by the communities instead of banks and governments and regulators. So in the next few slides, I'm going to attempt to go through the major features of both CeFi and DeFi and how do they compare to each other, ultimately enticing you to make a decision which one of these financial services is better for you as an investor. So let's start with accessibility. How would you access a CeFi or a DeFi solution, and what would be the difference? With CeFi, you have a nice user interface which prompts you usually, and I have to say a personal advice, if you are going for a CeFi solution, make sure you go for one that adheres to anti-money laundering rules or is regulated, or both. And if you do that, you will be prompted to go through the so-called know your customer, the KYC process, to access the services, which means that you have to share your personal information, typically your ID card, a selfie of yourself, some information about yourself, the intended nature of your business with that company. So before you are allowed to enter the premises of or the products of the company that the company offers, you have to provide certain information about yourself. And this information is typically collected because of regulatory obligations of the CeFi entity that offers you the trading or the custody of funds, you name it, whatever service you want to sign up for. How about DeFi? So DeFi, as opposed to CeFi, is permissionless. What does it mean? You don't require a permission by someone to get access to these services. So DeFi users can actually directly access the services using a wallet, a non-custodial wallet, which can be a software or a hardware wallet. And you don't have to provide personal information. You just need to connect your non-custodial wallet to the DeFi application. This means that DeFi is practically openly accessible to all parties without any barrier or without any discrimination based on your jurisdiction or the country that has issued your passport, for example. Moreover, individuals who plan to build on top of the centralized platform can actually do that freely because DeFi platform provide a high degree of accessibility and support collaboration within the community. And any product developed within the DeFi ecosystem is designed to benefit from other products and vice versa. If we look into how do these products differ in terms of convenience, you would notice the following. As I've said, CeFi products normally come with a very user-friendly interface that looks familiar, right? It looks like the sign-up process for any new bank or even traditional banking services that you may currently be using. So you would provide your names, regular information, nothing that you're not familiar with or not comfortable providing, especially in Europe. We're very used to the typical onboarding process that banks would have to accept new customers. So user-friendly interface. If you ever get stuck, you have customer support to rely on, so you can ask questions. The company is going to help you, get you onboarded. They're going to help you start using the products, etc., etc. So it's very familiar, a process that is very close to what we're used to. DeFi, on the other hand, can be a little bit challenging if you're not an experienced user, or if you're just a crypto tourist or a crypto curious, let's say. So it's a little bit, it requires a little bit of knowledge on blockchains and on cryptocurrencies, some degree of technicality, and it's not very intuitive for a large number of users. If we have to look at relatable terms, right, and if you think about your parents or your grandparents, if you want to introduce them to crypto, would you go for a centralized solution, or would you ask them to, let's say, set up a ledger wallet and connect it to a DeFi liquidity pool? I think that would give you the answer in terms of convenience of usage of CeFi and DeFi products. So how do we use CeFi and DeFi as a bridge to traditional money? As you know, a lot of the crypto curious, or the, let's say, the early majority and late majority users would actually not be native crypto users. So typically, such users would need to exchange their fiat currencies for cryptocurrencies so that they can start tapping into the industry. And normally, centralized financial services would actually always offer you some sort of fiat on-ramp and fiat off-ramp. So if you decide to go out from your crypto investments, you can actually take your money to your bank account, and that would be it. And there is something else. Apart from the ability to buy crypto easily with fiat, CeFi exchanges and CeFi providers would actually support the trading of Litecoin, Bitcoin, Ripple, you name it, any other kind of frequently traded high market cap coins that are issued on independent blockchains. Whereas such coins are typically not available to the centralized applications. And of course, the majority of the centralized applications actually have no bridge whatsoever in terms of fiat money. And that obviously may not be a blocker for anyone who has been a crypto native and has been trading in crypto for a number of years. However, if you're a new market entrant, you may actually benefit greatly from the ability to add your bank account, to deposit funds, to be able to invest in cryptocurrencies. So how do these two applications differ in terms of privacy? In Europe, we have become largely aware of our privacy rights, the rights to protect our data and our identity and our personal information, the right to control how our personal information is used by third parties. Who do they share it with? Do they use it for marketing purposes, etc., etc.? So with the introduction of GDPR, we clearly have become, let's say, experienced users of data privacy rights. Then CeFi would allow you to place trust in a single centralized entity. So you're placing trust in the company that you're contracting, which controls your money as a custodian. It both applies to your fiat transfers and to your crypto transfers. So the centralized entity would hold custody of any deposits that you place within their accounts. And of course, they would be collecting personal information from you. So any personally identifiable information, as GDPR are coded would be owned or accessed and owned by the data controller, which will be the CeFi entity offering the services. So as a user of these services, you're trusting the good governance and the control practices of the firm that you have chosen to safeguard those for you. So as such, you are facing the third party, the counterparty risk of this company, either leaking your data or being hacked and somebody stealing your data, or they have been negligent with the information you have provided, which has led to exposure of your data, or God forbid, to loss of any funds. So this is how privacy is addressed by CeFi applications. So what you have to do as an investor is clearly looking into who these companies are. Do they adhere to international benchmark standards for privacy and for security, like the ISO standards out there? Do they have adequate processes if something happens, if there is an account statement, a compromised event? Do they have enough support team to be able to address quickly any issues that you may have? Are they regulated? Is there a higher instance that you can go to? Do you know which country are they located in? Do you know who the regulator is? Do you know the ombudsman details in that country so that you can contact them if anything happens? So you are putting your trust into an institution just as you would be putting your trust into the bank that, let's say, safeguards your fiat money. In DeFi, it's completely different. So users, you as a user will have full control of your data, your money, and your identity, because you don't have to share personal information for you. When you're creating your non-custodial wallet, you would be asked to memorize, and normally not by heart, but more like write it down somewhere, 12 phrases, which would allow you access further to your wallet if you need to access it again. So if you lose the key to your wallet, you are losing your money and you're losing anything that goes with it. So you have full control of your funds, you have full control of your data, but you also have the full responsibility over the way you are using this data. So it all depends on you and how careful you are to safeguard your own money and your own information. Speaking about regulation, there is no regulation in decentralized finance, right? Because it is a peer-to-peer exchange that has no intermediaries, and users would be depositing funds in what practically is a smart contract. And while regulators and government are now looking into the DeFi networks and the solutions, and they're trying to get their head around how to regulate such industry, and is it even possible to regulate such an ecosystem? Is it normal, or let's say, is it safe for the investors to put funds in it? We have to say that, especially in Europe, with MiCA, the centralized financial institutions are going to be very soon regulated. And even at present, the majority of the European Union countries have actually adopted the fifth anti-money laundering directive, which actually mandates that crypto providers are registered within the territory of each European Union country for the purposes of AML and CFT regulation. And then further down the road, any crypto provider that operates from the territory of Europe would actually have to obtain a license under the MiCA regime. And this is maybe a couple of years down the road, but as you know, there are certain European countries like Malta, for example, where I reside, that already regulate cryptocurrency firms. So there is definitely a lot being done in this aspect. And it's not just Europe that is pushing down legislation, it's also the US and other countries following suit. And in centralized finance, this is the world that we're looking at further down the road. It will not remain unregulated, but more likely the crypto services industry would be fully regulated. And it is likely that these regulations would actually be reminiscent to the markets directive, for example, that is currently active in Europe. So what are the risks? I've mentioned on a couple of instances what you should be aware of as investor, or just as someone who wants to maybe hold crypto in a centralized or in a decentralized product. So centralized exchanges are subject to an increased amount of cyber attacks because they hold custody of user funds. And obviously, any funds are as safe as the safeguarding measures that the centralized financial services provider is able to secure. So you are putting a lot of trust in the ability of a single entity to safeguard your funds. And obviously, it is only a matter of time if a provider becomes big enough, if they have enough assets under management, that somebody would try to steal these funds. It's only a matter of time. So you have to be very carefully making a very thorough research about the security practices and the data privacy practices of the centralized provider that you have decided to trust your funds with, because it's not just about, let's say, the CEO of that entity ensuring you that your funds will be safe. You have to make sure that you do your own, so to speak, audit of that platform to make sure that if something happens, your funds would actually be safe, whether it's going to be an insurance that they have in place for customer funds, or publicly available information that the customer funds are stored in cold storage, which is not connected to the internet, meaning that it's not at risk for being attacked by hackers. Of course, there are no such risks in the centralized exchanges, right? Because the platform does not store user funds. You are the holder of your own funds. But this doesn't mean that there are no risks in DeFi. And actually, DeFi users should pay attention to a lot of things, such as the code of the application, the consensus algorithm that is used by the DeFi projects, and etc. So these are always things that you need technicality to be able to assess and to monitor, right? Because the underlying technology sometimes comes with bugs, and it's only normal. Every technology comes with bugs and other issues. And due to the nature of DeFi, many protocols are actually being built by smaller companies, limited teams that have limited budgets, and this can really increase the risk of smart contract bugs. And even in the case of bigger protocols, let's say protocols that are being audited by reputable auditing firms, there are still vulnerabilities and bugs discovered all the time. And due to the immutable nature of blockchain, this can actually lead to the loss of user funds. And if you need to take this into account, please make sure that you know the project before you lock your funds into a smart contract. And remember that it's a smart contract that you're sending your funds to. It's not a company. There are no people that can help you. There is no customer support, no regulators, no higher instance to complain if you lose your money. In addition, I have to mention one of the biggest advantages of DeFi is also its greatest risk. And this is the idea of composability. Composability is a design principle that allows various different components within the system to be combined together to meet any specific use case requirements. And DeFi is very unique in that developers can actually leverage the combination of DeFi protocols. So something that they have developed with something that already exists on the network, and they don't require any specific permissions to use these components, right? It's permissionless, and it's open code, it's frictionless and very innovative, and there is nothing like this that is currently seen in traditional or centralized finance. But that, of course, exposes all the products to certain risks, and you can define those in like 4 general categories. So category number 1 would be the inherent protocol level risk of the blockchain network, right? So if the base layer, if the network is unable to come to consensus or gets attacked by nefarious players, by hackers, then everything that runs on top of that network would actually be vulnerable to the manipulation of the hackers. The second one would be the unique implementation risks of each smart contract application. So every application is based on its own design and operational specifications. And to mitigate these vulnerabilities, the network has to perform, or can perform in certain cases, smart contract audits. They can offer bug bounties, they can open the code and just invite everybody to review the code and to point out bugs and to fix them. But there is still that smart contract risk and the code that has to be reviewed. The third risk involves the expansion of the attack surface when you are composing multiple smart contracts together. So that composability expands the surface. And while two particular decentralized applications can be secure in isolation, the combination of a two or three or more may not be secure anymore. And last but not least, the fourth risk involves the user knowledge and accessibility. A user who does not understand the application they're utilizing is much more likely to take more risk than what they realize. It is for that reason that education and transparency about the risk of using DeFi is extremely necessary for a healthy DeFi ecosystem, because the DeFi composability can actually quickly get highly complex, and it can definitely be a barrier to a lot of users understanding what they're putting their money into. I see I'm getting a hand raised for attention.
Hello, Mariana.
Hi.
Yeah, I mean, I would love to be here for another hour. It was very interesting, the presentation, but unfortunately, we're running out of time. We have also a few interesting questions already.
Sure.
Yeah, I mean, we're 2 minutes out of time, but if you want, we can answer a couple of questions quickly.
Absolutely.
Okay. For example, I'll send you a couple of questions. First question, does Crypto.com plan an IPO? That's one question. And then another question is, do you think that by 2025, we will see crypto wallet in every pocket?
On the first topic, it's very difficult for me to assess that information, and it's not something that I can actually tell out loud before it has been planned on, or the management has decided to put this information out there. So I would choose not to answer. So the second one was whether we will see cryptocurrency in every pocket by 2025. That's a very definite prediction. I'd say, and maybe by 2030, we would see cryptocurrencies in the majority of pockets, mainly because of the rise of CBDCs as well, and of bigger banks warming up to the idea of accepting digital currencies.
Thank you for those questions. And then we have another question. We have several, but
Sure.
For example, does Crypto.com plan to offer Ethereum 2.0 staking?
I'm actually not aware if we are planning to do it, but that's something I'm going to check internally. And if you give me the details of the person who asked that question, I'll be happy to reply after.
Right. Thank you so much. Unfortunately, we'll have to leave it here. We are a bit late, and we have the next session here open in the next room next to me. Thank you so much, Mariana, for putting